How do I use that towards my benefit? Or is there any benefit of doing that?
Yeah, so here's the thing. The biggest write-off that anybody can get in America is real estate, right? So we've got a W-2 employee and saying, hey, I want to get a nice write-off, want to reduce my taxes. First of all, there's something that's called business loss limitation. They can speak to their tax advisor about it, but they can still take a few $100,000 of losses from the from short-term rental. But you have to qualify, right? Because real estate is a passive income or passive loss. In order for it not to be passive, you need to materially participate in it like you would in your business. So for a W-2 employee to qualify to take those losses, they have to meet three tests. Test number one, the average stay per tenant has to be 7 days or less. Test number two, they have to materially participate 100 hours. You usually don't meet this test. Normally, it's hard to meet it. I shouldn't say you don't, but hard to meet if your property is in another state.
What if your business is making more money every year, but your wealth isn't growing with it? Revenue rises, profit improves, and business expands. Yet money may still be slipping away through outdated business structures, mixed tax planning opportunities, insufficient compensation, and decision made too late. Because strategic tax planning isn't simply about loading tax bills, but it's about keeping more capital working towards your business investments, and your future. I'm Vinki Loomba, your host, and today we are uncovering the hidden tax leaks entrepreneurs often miss and exploring how proactive planning can turn business success into lasting wealth. My guest today is Boris Musheyev, founder of BORISMTAX, a tax planning and advisory firm focused on helping entrepreneurs and business owners move from reactive tax preparation to proactive tax strategy. Boris is also host of the Tax Reduction podcast, where he shares insights on tax planning, financial structure, and wealth retention. His company has also been recognized on the top 5,000 list. So, our topic for today is making millions but losing wealth, the hidden tax leaks. We'll explore why profitable business do not always create wealthy owners, where hidden tax leaks may occur, and how entrepreneurs can responsibly tax planning as part of a broader wealth building strategy. So, Boris, welcome to the Wealth Vibe Show.
Vinky, thank you so much. That was a really nice introduction. A long one about me, so that's good.
So, I think let's start with your journey basically. When did you first notice that many successful entrepreneurs knew how to make money, but now how to use tax strategy to build wealth?
Well, my journey, just like with other accountants, started as a tax preparer. I was doing tax preparation. I was working with boutique CPA firms here in New York City. And we were doing personal taxes, but we were also doing business taxes. And our job was just to do tax preparation. So when business owners came to us and I was doing their taxes, they're like, okay, great, I made all this money, but what else can I do? I'm like, well, the year is already over. You can't do anything, but you can do these things to save money on taxes. Like, okay, obviously they were upset they have to pay so much money in taxes. And then I gave them the list of things they need to do, and they left. And this is just me preparing their taxes. They left, obviously did not take any action. Next year, same problem. More money, same problem. So when I went out on my own to start my own business as a tax accountant, I had no idea how I want to structure my business, what type of business I want to have. I never worked for a firm that did tax planning. And there's very few firms, by the way, that do tax planning. You should know that, Vinky. There's either big accounting firms that do tax planning for very major big clients, and there is a smaller firms that are top 100 accounting firms, Vinky, and you will be surprised that they just specialize in tax preparation, bookkeeping, and financial planning, but no tax planning. I know top 100 accounting firms that do not do any tax planning. So when I started my firm, I didn't know that was going to be doing tax planning. And I came across a few things. I'm like, you know what? I actually know tax very well. And that's what I can do and work with business owners on. And that's when I started. That's my journey started doing that about 9 years ago.
So you highlighted something very important here. You talk about two things, tax planning and financial planning. So I would like you to tell us the difference between the two and what made you think, oh my God, there's a huge gap in the market. Let me tap into it.
A huge gap in the market of when I say in the market, meaning so like business owners need to understand tax planning is not the same thing as a financial planning. These are two different, differences, big different things. Financial planning is where a financial planning firm will help you financially plan the assets that you own, the money that you own, and how to invest it properly. That's the first part of they do. The second part that they do, they can find you vehicles that the money that you can invest can be tax-free. For example, they can do some kind of life insurance policies or whatever that may be, or cash balance plan, which is all good. But that's not tax planning, right? That is like more like a future tax planning. That is a tax-free retirement, which I'm a fan of. And I like when people plan for their future with the financial planning. Then there is something that's called tax planning. Tax planning equals income tax planning. That means your plan to reduce your taxes on the income that you receive. Two different things. Okay. So sometimes I've met business owners, they said, no, I already have a financial plan. I'm like, I understand that part. I'm like, you don't have somebody who's planning for your income. These are two different things. Does that make sense?
Yeah, it does. So can you dig a little bit deeper and tell us what exactly you do that, the income tax planning? Because I think for example, take the W-2 employee as an example, right? They have very limited ways to tax write off their income.
Yeah, no, I like that example. So let's kind of put that into two columns, right? We've got, let's say, a W-2 person who just earns W-2 and a business owner. So a person that earns W-2, like you said, they're very limited, unfortunately. The highest taxed individuals in America are people that work for somebody else.
Exactly.
And that is they're receiving W-2 income. There's not a lot of planning strategies. Yes, they can invest in real estate. You know, their spouse can become real estate professional, but not a lot of them are educated about it. And usually when a person is W-2, their spouse is also W-2 because they need both incomes. So one cannot even become a real estate professional. Other strategies they can use is they can invest in short-term rental because that produces depreciation, which produces nice deductions. But again, it's very, very limited as to what they can do. Then you take a business owner who brings in high profits, W-2, and maybe income from other businesses. Now, that's where tax planning comes in. Like, all right, you've got this income. Let's find tax strategies that are allowed in the tax code to bring down your taxable income. Let's say from $1 million to $600,000. So now instead of paying tax on $1 million, you pay tax on $600,000, and that's tax planning.
Yeah, but see, a lot of entrepreneurs, they know that to somewhat, I would say, not 100% like you're so knowledgeable. But why do some entrepreneurs, still build highly profitable companies, but still fail to create a meaningful personal wealth outside their business?
Honestly, I think about it a lot, Vinki, and I think it has to come down to personality. Right, so you've got entrepreneurs that will work really hard, make very high profit, and they pay taxes, but they're so engrossed in their business and making high profits that nothing else matters to them. And they hate taxes and they don't want to talk about it, they just want to pay for it. Then you've got other business owners that are more financially responsible. And they will allocate time to work with a tax advisor to reduce their taxes. Because when you do tax planning and you hire yourself a tax advisor, you can't just be like, here, I hired a tax advisor and they're going to help me save money on taxes. It takes two to tango.
Mm-hmm.
Correct? So that business owner needs to show up to the meetings with his tax advisor to save money on taxes. So why are still a lot of business owners overpaying? Two reasons. They either choose to or they're not educated enough. To this day, we enroll clients for tax planning. They're like, I didn't know I could do this. I didn't know there's such thing. Just before this call, I got off the call with a doctor that is making $4 million approximately in his business profit, owns a lot of real estate portfolio, has about $1 million in deductions that are sitting in his real estate portfolio that he did not know is there. And now with simple tax planning, restructuring a couple of things, he'll probably get about $1 million write-off in 2026. And mind you, this doctor is 69 years old, never done tax planning for himself. I mean, at the end of the day, right, that's what it comes down to. And let me be very clear for all of you listeners. I was one of the first people that was promoting tax planning for small business owners. On social media, I started my marketing on LinkedIn. Okay.
Mm-hmm.
Now we have a lot of accountants that are caught up with this idea that business owners are willing to pay extra for tax advisory, tax planning. Now everybody's advertising themselves. I'm a tax advisor. I'm a tax planner. I can help you save money on taxes. And most of them cannot. Okay, so when I give an advice and I go on podcasts and business owners ask me, and podcast hosts like yourself ask me what can people do to protect themselves against another tax preparer that is hiding as a tax planner, I tell them, ask that person that you're about to hire as your tax advisor, that you're about to pay very good money to help you. Do they have proof of concept? Do they have clients that they have done this for? You don't necessarily need to ask for a reference. But if you have a reputable firm that does tax planning and advisory, there's enough information about you out there and the Google reviews and the video testimonials, and you can show these are the things that we do. And this is an advice that I would give to every business owner that is making profits and now like, look, I need a tax advisor. Yes, you need a tax advisor, but also do your due diligence about who you hire.
Mm-hmm. That's true. I agree on that. So let's go back to our W-2 employee example that we were using earlier. You talk about the STR, the short-term rental, because it's an active income from the short-term rental, and they can use that to offset their W-2 income, right? Because if they have losses there. But how does that work? Would that work if they're out of state and hire a property management company to manage it and all that? Because people get entangled with that thought too. Oh my God, this is out of state, somebody else is managing for me. How do I use that towards my benefit? Or is there any benefit of doing that?
Yeah, so here's the thing. The biggest write-off that anybody can get in America is real estate, right? So we've got a W-2 employee and saying, hey, I want to get a nice write-off, want to reduce my taxes. First of all, there's something that's called business loss limitation. They can speak to their tax advisor about it, but they can still take a few $100,000 of losses from from short-term rental. But you have to qualify, right? Because real estate is a passive income or passive loss. In order for it not to be passive, you need to materially participate in it like you would in your business. So for a W-2 employee to qualify to take those losses, they have to meet 3 tests. Test number 1, the average stay per tenant has to be 7 days or less. Test number 2, they have to materially participate 100 hours. You usually don't meet this test. Normally, it's hard to meet it. I shouldn't say you don't, but hard to meet if your property is in another state. You could still meet it, right? But what becomes a problem is that when you hire a property manager to manage that property, because most likely that property manager spends more hours than you. So IRS says it's nice you've got 7 days average stay. It's nice that you materially participated more than 100 hours. But if you got a property manager that's participating more than you, then you lose that ability to take those losses from short-term rental.
Mm-hmm.
So again, if you have listeners that are high W-2 earners, even if you're a high W-2 earner, don't hire just somebody who does your taxes. Hire a tax advisor. Could there be other strategies that you could use, such as short-term rental? Yes. And then the tax advisor will tell you, hey, you'll not be able to take this deduction, but if you structure yourself this way, you'll be able to take this deduction.
So it's like highly personalized, customized approach. So it's not like a kind of one thing that fits all, right? Basically, that's what you're trying to say.
100%. It is never a one thing fits all for anybody, right? So every business owner is different. Every W-2 employee is different. Everybody's situation is different. Everybody that's W-2, they have a spouse maybe that's starting a side job, or they have a non-working spouse. Now they can invest in real estate. Things happen, right? Things happen in planning. Everybody's situation is different. So not everybody created equal when it comes to tax planning.
Okay, so our topic for today is hidden tax leaks. So when you describe a hidden tax leak, what exactly do you mean?
It can come down to a number of few things. Number one is compliance. Is your tax return properly prepared? Even though we're talking about tax planning, but this is very important. Coming back to this example, the doctor that I just spoke to you about, he paid himself a few $100,000 on a W-2, but it was not properly reported on his business return that he as an owner took out a salary. That's a leak because that is an IRS audit. Okay, that's number one. Number two is the deductions. For example, when we talk about tax leaks, right? Everybody can think of it differently, Vinky. Like, what's leaking from my taxes? It's like
I know.
you're not taking enough deductions, right? Like
Okay.
again, back to this doctor example, he has about $1 million sitting in cost segregation depreciation deductions that he can take against his active income. Then he had another strategy, for example, that it's a state-specific strategy that would, if his accountant did this properly, without him investing any money, he would have gotten another $400,000 in tax deductions. A leak, right? Whatever you refer to as a leak. So there's many different things depending on everyone's situation. In this particular situation, that was that.
So, but why would he do that, right? The cost segregation or the bonus depreciation, that was pretty obvious. Or the word that you use is cost segregation, right? That was sitting there. That was pretty obvious losses that he got. So,
Vinky, you are, I don't mean
it's
to
like,
interrupt you, but you are wrong on this. I was wrong on this also, just like you when I figured out when I started working with business owners, wait, this is obvious. It is not so obvious to them. They don't
okay.
know. They're doctors, right? Or whatever it is their business that's have they're running. That's what they do. Okay. And the accountant that you work with should tell you, hey, this is obvious. But when you start your business, Vinky, you know what happens with a lot of business owners when they start their business? They're very small. They're just starting out. Who do they hire? A small-time accountant.
All time
So
accountant.
then the business grows by far a lot, but this accountant continues doing taxes for small business owners, not for already a grown business. And it's not obvious, not to the accountant, not to the business owner.
People usually start with a smaller CPA because they don't want to spend too much money. So what I wanted to know from you is what is the practical difference between preparing taxes and proactively planning for them? And why many people are confused between these two different ways of doing taxes. Uh, I know eventually it's going to get costly if they don't do it the proper planning, like you gave the example of the doctor, because that he can say it's an oversight, but so many years you are losing that money or you just letting the money sit on the table and not utilizing it.
It's because people, when they hire an accountant, they think, okay, my accountant got it handled for me. And they place their trust in their accountant for many years until the tax bill becomes unbearable. So people don't understand. Wait a second, my accountant was not doing tax planning this whole time. I get this all the time from business owners, but I thought my accountant is doing it for me. No, your accountant has been preparing your taxes, and sometimes they even do a great job at it. But business owners don't know any better. They don't know, hey, there's a difference between preparation and there's a difference between planning. Right? They think my accountant is already doing everything that I could possibly get as a deduction on my taxes. Later on, as they start making more money and the tax bill becomes higher, is when they start questioning it. And that's when they start looking for somebody else. And when they start looking, they discover, oh, wow, there is tax planning.
I wanted to ask you one thing here again, one more time. I think we talk about that difference between the planning and the preparation, tax preparation. Tax preparation is, right, every year, whatever your tax year is, April, October, whatever, you prepare the taxes and submit your package there. But the planning starts way earlier, when at the beginning of year, whenever the tax year is, that's where the tax planning starts. So if you can guide us through that, how does that work? That planning ahead of time, what kind of mental reset you need, or what kind of hat you should put it on to understand or have a holistic picture. Oh my God, this year is going to look like this for me, so that I know ahead of time and I have all the strategies in place to save money. And that could be my wealth building strategies. That's really, really important.
I think once the business owner understands that they need tax planning, then they will start proactively using the tax strategies and planning. And that this is where it comes in for them to work with their tax advisor. Yes, tax planning cannot be done in January for prior year. Tax planning has to be done at the minimum, at least mid-year or more. Can you start doing tax planning sometime in September? The answer is yes. There is still a lot of opportunities and strategies available. But the point is that like to your point, Vinky, it has to be proactive and it has to be done before the year is over, not after the year is over. So that's when and that is part of the tax planning, is it starting it way before. Do business owners start it late? Yes. Why? Because they're very busy with their business. Like when
Making
clients
money,
come
yeah.
when clients come to work with us, one thing I tell them, and like I think I told this doctor also, it takes two to tango. Just because you hired Boris to do your tax planning and advisory, and I save my clients hundreds of thousands of dollars on taxes, just because you hired me that I can do this, doesn't mean I can do it for you. We have to work together. We have to meet. We have to do this proactively together.
So, what is the most expensive misconception entrepreneurs have about taxes?
Most expensive misconception that they have about taxes
Mm-hmm.
is that my accountant got it.
Ah, that's a good one. I was hoping for that answer. And let me ask you the next question. A company may begin with a relatively simple structure, but its revenue, team, and operations can change significantly over time, like we've been talking about that earlier too. So, what are some of the warning signs that a business has grown out of its entity structure, their compensation strategy, or their financial systems, and they should know that this is the time maybe to find the right person who can give them the right strategies?
I think if you're just starting a business, once you get to $100,000 net profit, you should explore getting into an S corporation. Once you start making $2 million in net profit, you should explore an additional entity such as a C corporation. Obviously, you have to speak to your tax advisor about this, okay?
Mhm.
And to make sure that you can set up some strategies to do some income shifting. But again, you have to meet certain qualifications, make sure you're doing it properly. So speak to your tax advisor. If you own real estate, then there are strategies involved putting properties in real estate, inside LLCs, excuse me. Now, does that mean that you have an LLC going to save money on taxes? No, but you're creating yourself kind of an asset protection for that, and liability protection. And again, more speak to your tax advisor more in detail about that. But to answer your question directly, for me, for my clients, we kind of focus on these numbers, right? If you're $100,000 net profit, the best, or it's probably good to become an S corporation. $2 million in net profit, which we have a lot of clients that have $2 million in net profit. We start exploring opportunities of introducing other entities. Okay. Also, like for example, when somebody reaches $2 million net profit, they start thinking about exit, exiting their company at some time in the future. So if you want to exit your company sometime in the future, there's another planning opportunity. There's another opportunity to bring in another entity structure into it.
Yeah, exactly. And that's like starts way ahead when you're planning to exit. I agree on that. And I think a lot of people talk about the deductions too. They're like focused on the deductions, especially the W-2 employees. And then what do you think about that? Is like just like focusing on deductions only can help you, or you need a broader planning than that?
I think if people just talk about deductions, they don't understand deductions. Right? It's just like, so, okay, deductions, like, so what? Like, I think it was Seinfeld. It's a write-off. Who said it's a write-off? They said it's a write-off. You've seen that clip? But no, people need planning. If they're making significant amount of money, whether W-2 or business income, they absolutely need planning. Planning, it comes with deductions, it comes with credits, it comes with entities. All of that can be utilized to their advantage.
Hmm. So I'm going to shift the gears here. We've been talking about how to save money in taxes or how to do the tax write-offs. So I wanted to ask you, when you're saving the money, the in taxes, that does not automatically create wealth. That retained capital still stays with you until unless you use it usefully. Do you advise your clients to put it in a proper channel so they are generating more wealth for themselves? And it's kind of a continuous effort at both ends.
Yeah, I think everybody should understand this, and this is actually something we're starting to do right now this year with our clients. Is that first of all of our clients know exactly how much money they saved on taxes, right? So they know exactly whether it's 100,000, 200, 300, 400, 40,000, whatever that is. Right now, we're shifting gears to actually teach our clients. Again, it's all about education. Like, look, this is the money that you didn't have before. This is the money that would have been paid somewhere. Why don't you take that money and start building yourself a financial future, right? Wealth building, like you said, a wealth transfer to your children. So I think that once you start doing tax planning and you generate savings, those savings could be leveraged. It's the money that you didn't have that you now have to start some kind of an investment. That could be any type of investment. Everybody can start little, grow big, whatever that may be.
So, what mistakes do you see people make after successfully reducing their tax burden? They have saved the money, right? So,
I think I don't know if I've seen a mistake after they saved on a burden. Like everybody, if they were making a mistake, they were making the same mistake before, right? If a person was buying Lamborghini every year, whether before savings or after savings, just because he likes it, like it doesn't mean he's not making the same mistake. But if I had to really answer that question, I would say they don't know exactly what to do with their money properly. And that's where financial planning comes in, right? I'm not a financial advisor. I don't do financial planning. They may not have a good financial team in place to do these things. But I would say that if you save two or $300,000 on taxes, you need to get some financial planning done or start investing in real estate.
oh, okay, that's good. So, financial planning and the tax planning goes hand in hand, right?
Yeah, I never said they wouldn't go hand in hand. They're just two different things. Because sometimes people think if I have a financial advisor, then I must be saving on taxes. It's not true. If you saved on taxes via tax planning, you can work with a very good financial advisor to manage the money that you now saved.
Mm-hmm. Great, that's good. So this is really good. So I did have one kind of a scenario question for you that I'm gonna ask you. You gave me the scenario of the doctor already. So, but I wanted to think about an entrepreneur, who owns a business generating $5 million revenue and $1 million in profit every year. So the company is growing, but the owner only meets with a tax professional after the year has ended. They have never reevaluated their entity structure, compensation, retirement planning, investment strategy, or a long-term wealth building goals. So if you could examine only 5 areas to uncover the largest potential tax and financial leaks, where would you look first and what questions would you ask?
Five. You want me to do the whole tax plan on the show here, Vinky?
Just like in like a crash course for us, a little bit here.
Right, so it's $1 million profit. The year is over. The good news is that there are still some strategies that you can use retroactively, even though the year is over. For example, you mentioned retirement. I would ask them how many employees do they have. If they have under 15 employees, I normally recommend, hey, you can set up a cash balance plan, you can put away at least $200,000, and you can do this for last year. So even though you
Mhm.
didn't have it set up and you didn't file your taxes, that's the first thing to look at. And a lot of people like that, and they do make that happen. The second thing I would ask if they own a real estate in which their business operates. Because if they own a real estate in which their business operates and they're 100% owner of their business and the real estate, those losses become deductible. They're not limited to passive loss rules as if it is a regular real estate. That's the second thing. The third thing I would take a look at is that their PTET, have they paid pass-through entity tax? So can't do anything about it for last year, but you can do about it for this year and going forward, right? You can switch how you pay your taxes instead of personal, make it as a business and get a deduction. The fourth thing that I would take a look at is their salary. I would take a look at their salary and see if they're overpaying themselves. In most cases, the business owners overpay themselves a salary. We do a reasonable compensation analysis, bring it down and help them there, restructure their compensation, include health insurance if they're an S corporation owner part of it, because they save additional Social Security Medicare taxes. That's the fourth thing. And the fifth thing, I will see if they have children that are under the age of 18 and hopefully over the age of 10 that they can actually employ in their business, pay them a salary, do some income shifting. Those are five things right off the bat. I hope I passed your test, Vinky.
You did. Oh my God, that was pretty awesome. Thank you for doing that. So this brings us to a rapid fire round. So I'm going to ask you 5 questions and spontaneous answers, no overthinking. Answers should be in one word or one sentence only. Are you ready?
Yes, please.
So, what is one habit you will never give up?
Learning more.
I like that.
Self-development.
I like
Self-development.
that.
I don't think
Yes.
I will ever give that up.
What book would you recommend every entrepreneur should read at least once?
$100 million offers by Alex Hormozy.
Oh, that's a good one. What is one word your closest friends would describe you as?
Kind.
I like that. What is one place in the world you always return to mentally?
Oh, my home.
Good. So finally, what is your wealth vibe?
My wife and my children.
Oh, great. So, Boris, it was a great conversation. So, for our listeners who wants to reach out to you and learn more about your work and wanting to connect with you, tell us how they can do that.
Well, if you are a profitable business owner, we have a training um, on how you can save $100,000 or more on taxes. They can just go to save100know.com. It's totally free. I personally did that training, showing you strategies that can amount to 100,000 or more in tax savings. That's save100know.com.
Great. Thank you very so much for joining us on the Wealth Vibe Show today and helping us look beyond how much a business earns and how much they can save. And for everyone listening, here is the question worth taking with you today. Is the financial structure evolving as quickly as your business, or are yesterday's decisions quietly limiting your tomorrow's wealth? So stay inspired, stay intentional, and keep building your wealth vibe.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.